In this lecture, we will see how to calculate payback period, how to make lease or buying decisions, and thinking out of the box. Let's look at the payback period. The time it takes to recover the cost of a purchase is called the payback period. The payback period is determined by dividing the cost of the purchase by the annual cash inflows the purchase is projected to return. Payback period equals cost of purchase divided by annual cash inflows. For example, if you bought a new production device worth $15,000 and the projected annual cash inflows for this device is $5,000, the payback period would be 3 years. The payback period is a simple calculation. It does not calculate profitability, nor it does factor the time value of money. There are other calculations like net present value or internal rate of return that could calculate this for you.